Look, this isn't some vague, far-off prediction. We're going to break down a very specific, time-bound warning about a US debt crisis from one of the sharpest minds in finance. The question really isn't if it's going to happen, but when. And, well, that timeline, it's a lot shorter than you probably think. Let's get right into it.
All right, so we're kicking things off with a real paradox. You look at the markets, right? They're sitting at these insane record highs. On the surface, you'd think everything's great. But just underneath, there's this weird, unsettling stillness. It's a kind of fear that's just frozen everything in place.
And this, right here, this is where that fear is coming from. Billionaire investor Ray Dalio, he didn't just give a vague warning. No, he put a date on it. Think about that. He's essentially scheduled a heart attack for the entire US economy. So you have that really grim forecast on one hand, and on the other, you've got this number. That's the S&P 500. It's a huge, staggering figure. I mean, it shows how resilient the market can be. But at the same time, it feels like we're standing on the edge of a cliff. The whole market is just holding its breath. And this one word, man, it tells the entire story. The official analyst rating on the index is hold. Now, for those who don't speak Wall Street, that's basically a polite way of saying, we have absolutely no idea what's coming next, but we are terrified to sell. It's like the official memo for that deer in the headlights moment. So this is what Dalio's prophecy looks like on a timeline. And you can see this isn't some distant, maybe one day future. It's right there, staring us in the face. That highlighted window, 2027 to 2029, that's the impact zone. That's when all this math is scheduled to finally hit a brick wall. See, these aren't just abstract risks anymore. They're becoming scheduled events, and they have symptoms you can actually see. And honestly, that's the whole reason this channel exists, to track these kinds of shifts before they blow up and become obvious headline news. Okay, so let's get into the mechanics of why this is happening. This whole prophecy, it's not based on some gut feeling. It's based on cold, hard, and frankly, pretty terrifying math. This is the anatomy of the avalanche. This is the first number you really need to wrap your head around. $1.1 trillion. That's how much the US government is paying every single year just in interest on its debt. Let me be clear, this isn't paying down the actual debt, it's just the service fee. It's totally dead money, it produces absolutely nothing. Now, if that first number was the fire, this one is the gasoline, $9 trillion. That's how much old debt the US has to roll over. Think about it, a lot of this stuff was borrowed when interest rates were practically zero. Now it has to be refinanced at today's much higher rates. So that $1.1 trillion interest bill we just talked about, that's the floor, my friends, not the ceiling. And this is why it's a trap. The US fiscal deficit is running at 7% of GDP. Now, to be clear, that means we're spending 7% more than we're taking in. For things to be stable, to be sustainable, that number needs to be down around 3%. So we are spending almost double the sustainable limit, and this is during peacetime. So what does that mean? Well, let's just call it what it is. When you have to borrow new money just to pay the interest on your old money, you are, by definition, running a Ponzi scheme. That's it. The government is borrowing from Peter, the new bondholder, just to pay Paul, the existing one. I mean, just look at this chart. It shows you exactly how far off the rails we've gone. You can see our current 7% deficit just towering over the sustainable level of 3%. And it's way, way off our long-term historical average. This isn't just a small blip, you know? This is a complete structural break from reality. Okay, but here's where the story gets really complicated. And honestly, this is where most people miss the real picture. It's not as simple as saying the US is broke. There's this huge paradox at play. It's like a tale of two completely different economies living inside the same country. And this is the single biggest difference between today and 2008. You remember 2008, right? The problem was on Main Street. It was households drowning in debt. Well, today it's completely flipped. On one hand, you have the state, the government, which is in huge financial trouble. But on the other hand, you have the street, the average US household, which is actually surprisingly healthy. So the big question is, with all this going on, why hasn't the dollar just collapsed? Well, this table pretty much explains it. It's something people call the cleanest dirty shirt theory. As bad as things are in the US, you take one look at other major economies and you realize they're in even worse shape. Higher debt, worse demographics, you name it. For now, there's really nowhere else for all that global capital to run. So where does all this lead? what's the end game here? If the math is unavoidable and the rest of the world is in just as bad shape, what does the crisis actually look like when it hits? Well, that brings us to what's been called the heart attack scenario. Naturally, you've got to ask, is there any way out of this? Can this whole thing be fixed before the system actually breaks? Well, the answer is, in theory, yes. But in the real world, that's a whole different story. So Dalio himself actually has a theoretical solution for this. He calls it a beautiful deleveraging. The best way to think about it is like a controlled demolition. You have to inflict some pain, cutting spending, raising taxes, but at the exact same time, you print just enough money to cushion the blow so the whole economy doesn't just implode. It's incredibly delicate, but it's not impossible. It has actually worked before. But here's the reality check. To actually pull that off, the government would have to slash the deficit from 7% all the way down to 3%. That means deep, painful cuts to popular government programs or massive tax hikes on everyone. I mean, can you imagine? No politician could survive that. The political will for it it doesn't exist. So that logical, beautiful path, it's completely off the table. And right here, this is the crucial point. See, anyone can point out the problem. That's the easy part. But understanding what actually happens next, when the politically easy path is chosen over the one that's mathematically necessary, that's the real insight. And honestly, most channels just stop right here. This one doesn't. If you want to see how this story actually ends, it's a good time to subscribe. So if the elegant solution is impossible, what does the heart attack actually look like? Well, it's a chain reaction, a series of dominoes. First, foreign buyers of US debt start to get nervous, and they just disappear. Step 2, to stop interest rates from exploding upwards, the Federal Reserve is forced to step in and buy all that debt itself. And how do they do that? By printing money. Step 3, this floods the world with new dollars, which obviously causes the currency to lose its value. And finally, step 4, hard assets, things like stocks, real estate, gold, they all have to reprice higher to account for the now devalued dollar. So why should you take this sequence seriously? I mean, is this just some crazy theory? Well, because the early stages are already happening. Dalio's predictions are validating themselves in real time. Gold is already way up. The bond market is demanding higher interest rates for long-term debt. That's a classic sign of concern. And yep, the Fed has already quietly restarted the printing press. The prophecy, it's already unfolding. So what's the actual playbook here? What's the takeaway? Well, it's pretty clear. In this scenario, cash is not a safe haven. In fact, in a crisis where the currency itself is losing value, cash is the one asset that is guaranteed to be destroyed. The game plan then is to stay in the market, to own productive assets, things like stocks, ETFs, that can reprice higher along with inflation. And maybe most importantly, don't even try to time this thing perfectly, because in this kind of environment, sitting on the sidelines in cash just means you're being eaten alive. So in the end, it really comes down to a choice that, for all intents and purposes, has already been made. Kicking the can down the road is a choice. Refusing to take the bitter medicine of budget cuts, that means you've chosen the emergency surgery of a chaotic monetary reset later. The timeline is set. The avalanche is already sliding.